We're just waiting for the room to fill up. Expecting about 50 people today. And looks like we've got 30. And the numbers lined out. So whether we'll get more people later on or not, I'll go ahead and get started. If you don't know me already, my name is Pete Knorr. I'm a vice president, one of the advisors at Bogart Wealth. And we're going to cover the topic today, how discount rates affect the ExxonMobil lump sum. And of course, we'll be getting into what exactly the interest rates are at the moment and how we know that and where we think they're going. If you're not with ExxonMobil, don't worry about that. Most of what I'm going to say is generic. And when it's ExxonMobil specific, I'll try to remember to say that. I'm going to first spend just a few minutes introducing Bogart Wealth. So in the financial advice world, there's kind of two kinds of advisors, ones that work for a bank and ones that are independent and have no other loyalty other than to the client. And we're one of those. We're independent. So your interests are number one. Our clients have their accounts at Charles Schwab. So they are a bank, but we don't work for them. In fact, we pay them in order for our clients to be able to use their system. But you would have your account at Charles Schwab, and we would have a limited power of attorney to be able to buy and sell in your account and move money among your different accounts. We are fiduciary, which means that we're legally required to put clients first. If we have any conflicts of interest, we have to disclose those. Transparent fees. You can read these on your own at another time. And by the way, this webinar will be posted in the internet. I'll let you know about that in a minute. So this is our team, the advisors on the top line, and I'll come back to that at a later point. And the rest of the people to support the advisors supporting the clients. We also have a tax team, so we can do the full soup to nuts on tax planning, tax preparation, and filing. We have 3 different locations. I can't tell you whether they're all convenient for you, but started out in McLean, Virginia, just a couple of freeway exits north of Gallows Road, for those who remember that address, and then realized Gallows Road wasn't going to be in the family all that much longer, and so came to Houston. My office is the one in West Houston, and of course we have to have one near the spring campus, so there we are in Hughes Landing in the Woodlands. Our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. You can see what some of those items that we work on. But today we're really going to focus on this one right here, pension lump sum versus annuity analysis. And our not very well hidden agenda is that we would like to have a one-on-one session with each and every one of you. Our purpose in giving these informational webinars is so you can get a feel for our personality, what we know, and it maybe be more comfortable than meeting in a one-on-one financial strategy session. This is one part of our list of topics, and this list of topics came from people just like you. So if you have an idea of something regarding financial planning or retirement readiness, let us know. If we see the need, we'll add it. So retirement planning timeline was the first we ever did. It's very comprehensive. It covers every topic related to retirement, but only about 1 inch deep. Retirement income planning is my second most favorite one. Where's your income going to come from once you're retired? As you can see, the rest of these: Social Security, tax planning, estate planning, NUA, and other post-retirement strategies, long-term care, Roth traditional, and mega backdoor Roth conversions. So on to the topic for today: how do discount rates affect my ExxonMobil lump sum? Now, I should say before I get any further that I have opened the chat and also the question and answer box. So if you have questions, put them in either one of those two places, and I'll get to them as I notice them. So I see one comment up there already that says, please be sure you cover the grandfather. And I'm going to do that first. So what does that even mean? What that means is there is a law that came out. Well, it's called the Pension Protection Act of 2006, and it was passed in 2006, took effect in 2007, and had a 5-year period of time in which all companies had to transition to it. Okay, and so that 5 years is very important. It defines who was grandfathered and who wasn't. I'm going to come back to that on the next slide. First, the act itself. So one of the things it does is, in the interest of making sure that the pension plans are fully funded, is it limits companies on their ability to even offer a lump sum if they're not funded well enough. They have to be at least 80% funded to have a 100% lump sum option. Between 60 and 80, they can offer a 50% lump sum option, but no more. And below 60%, they can't offer a lump sum at all. Okay, so ExxonMobil's always very well funded. It also defines the discount rates that can be used. So here it is where the grandfather is split from everyone else. But again, I'll get back to that. It defines the actuarial table to be used. So before all of this, ExxonMobil kept their own actuarial table by keeping tabs on all of their retirees. Okay. After this law came into effect, they have to use the IRS tables. And as those tables get updated over time, they're showing longer life expectancies, but we don't have one yet from COVID. Okay. The company has to update the table that they use at least once every 10 years. And the last time they updated was 2018. So they're still using the 2018 table. And there hasn't been one that's come out since COVID. So the last one that got issued was 2019. It also allowed non-spousal beneficiaries to do rollovers from retirement plans. It allowed after-tax balances to be able to be rolled to a Roth IRA. It required the company match be diversified. So you remember there was a time if you wanted all 7% of the company match, all 7% had to go to company stock. Otherwise, you only got a 6% match. Well, this law said you couldn't do that. So, okay, you get the full 7% no matter what you put it into now. And it also raised the IRA and 401k contribution limits. They were like only $2,000 a year for IRAs before this law came into effect. They're up to $7,000 now. So, okay, now, grandfathered versus non-grandfathered. So this came into effect at the end in 2007, and they had until 2012 to implement it entirely. So what they said was basically, if you were going to be eligible to retire by December 31st, 2012, then your grandfather. Okay. But the way the company actually communicated it was they backed up and said, well, in order for this to happen, then by the end of 2007, you would have to be at least 50 and have at least 10 years of company service. Okay. So the way I translate that is you had to be born before 1958 and hired before 1998. So that would mean now that you are at least 64 years old and at least 24 years continuous service. Okay, if that's the case, then basically you've got this very simple 95% of the 30-year Treasury bond. You can look that up all kinds of places online. I find it most useful to go to the Federal Reserve Economic Database. That's what FRED stands for, and look at their daily series of government securities, 30 years. Okay, and you're still stuck using the ExxonMobil 2000 mortality. Okay, so you're getting like 2 years less life if you're a grandfathered individual. This is what this series has looked like going back about 40 years for the 30-year Treasury bond. And you can see that it's come down, 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 and down some more. And, you know, every now and then, like, you have a financial crisis. And so nobody wants to have stock or corporate bonds. They all go to Treasury bonds, and down, 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 down some more. So you can clearly see the all-time low here in early 2020. But I want to point out that even before 2020 came around, we were already at all-time lows pre-pandemic. All-time lows pre-pandemic. And the Federal Reserve does not control these rates. The market sets these rates. And the market said we should have very low 30-year Treasury bond rates. Well, they've come up, but they're not anywhere near close to what would have been considered normal prior to 2019. But then again, they may not have stopped going up yet. So, okay, so it's very simple. Really, all you do is take the weighted average of the 30-year Treasury. What do I mean by weighted average? All I mean is you don't take the monthly numbers and average those. You take the daily numbers and average those, okay? So every day counts as much as every other day, and you always have a dead quarter. So like the first quarter of 2022 right now is what will set the rate for third quarter. There's always a quarter in between that allows you to have time to decide, am I going to retire now or am I going to keep waiting? Or if you've already retired, am I going to take the lump sum now or am I going to keep waiting? And why would you do that? We'll come back to that later. Okay, so you just average it, weighting every day the same, take 95% of that, and then it's going to round up or down to the nearest quarter point. So it's always a quarter point. And what you can see is here, the all-time low was the fourth quarter of 2020 and the first quarter of 2021. All-time lows. And that it's come up and back down and it's going back up again. Now, because this is so simple, we can say things like, well, for it to pop up to 2.25, we're going to have to average 2.3317 or more for the rest of February and March. And if you look at what happened just the last week that we have data for in February, that's possible. It's possible that it's going to pop up to 2.25. It's not at all certain, but it's possible. And if you look at what rates have done in January, starting at 2 and ending at over 2.1, here starting at that 2.1 and going up from there, you'd say it looks very likely that it's going to end up at 2.25. But I'll tell you, nothing's ever that simple. Okay. Okay, so someone just said that, by the way, they're no longer using the 2018 actuarial table, that's been updated. And so I will check to see whether or not that actually agrees with what we're seeing in terms of the numbers that we get from ExxonMobil. It will be very clear to us when that change actually takes effect. Okay, so that was what happens to decide the interest rates for grandfathered people. Now for everybody else, so that means you were under 50 or had less than 10 years on December 31st, 2007, which means you were born after 1957 or hired after 1997. Then we're going to use these 3 segmented rates on high quality corporate bonds. The government calls that the high quality market, HQM. I don't think that's used by anybody else. Okay, corporate bonds have higher yields than government bonds, and higher yields are bad. But on the other hand, it's using 3 segments: a short-term segment, an intermediate-term segment, and a long-term segment. So it's not necessarily true that you're going to end up with a higher yield from these corporate bonds, although, in fact, it's always worked out that way so far. But okay, let's get into that in a minute. And they use these IRS mortality tables that, well, you know, we say here they're released by the IRS every year. Haven't seen one in over a year. Okay. And I already mentioned they have to update it every 10 years. Scratch that they're now using the 2018. Last I knew they were using the 2018. So these are showing longer lives, I mentioned, by about 2 years, and longer life is good. And we'll get into how good and blah, blah, that's what all the rest of this is about. So this first affected people who started retiring in 2013, and now, you know, it's a greater and greater and greater percentage of people, and running into a grandfathered person is rare, but not as rare as hen's teeth. Okay. So this is kind of what they look like, and the actual data only go back to 2013. These rates don't really exist in the real world. They're a model that the Treasury Department has to maintain. And what you see here is our model that tries to predict them versus the actual. And it's hard to spot, but there are a few places like right here where we said it was going down and the Treasury Department said, no, it went up. Okay. Or here we said it's going down and they said, yeah, but not as fast as you guys think it is. Okay. So most of the time we're really, really, really close at predicting what is going to get published. And again, I mentioned it's the Treasury Department that calculates this model. If you know where to look on the Treasury Department website, you can find these sometimes a day before they get issued by the IRS on its official website. Okay, so the way ExxonMobil uses these, and some other companies make a different decision, is that they're going to take the data like from the current quarter, January, February, March, to calculate the third quarter. So again, there's always a dead quarter in between as the data is coming out. and when it's going to get applied. But they only use the last 2 months in the quarter. So that's why I have January shaded here, is that, well, in January, we had no data about what's going to happen in the third quarter, but we said, well, let's just look at what January says and use January as at least an indication. Is it going up or down? Of course, you know, it's obvious it's going up, but by how much? Okay, so that was January. And as soon as we had one data point from February, it's like, well, January doesn't really matter, does it? In February, you know, right now, this is only going through about the middle of the month, the 17th. And you can already see that it's a lot higher. Okay, but how does that translate into the lump sum? We'll get there. We'll get there. We'll get there. Okay. Okay. So someone asked, do I think interest rates will come back down after the second quarter? Let's get into that in just a minute. But basically what you can see is February is undecidedly an upward trend, but it might have stalled. Okay. And if you look at like what was Friday's data point that's missing here? There isn't one for Monday because Monday was a bank holiday. You look at Tuesday, it looks like it might have stalled for a moment, trying to figure out what's going to happen in the world if there really is a shooting war that starts up in the Ukraine. So okay. To make the comparison simpler from one quarter to the next, we back calculate what we call the single equivalent rate. And we calculated the 2 points, 55 and 60. Okay. Okay. Now, someone asked a really good question here, which is, all right, I'm talking about quarters that these things apply to, but what does that exactly mean? And here is another case where life is different if you're grandfathered than if you're not. So this is what the ExxonMobil plan says. The discount rates that will be used are the rates that are in effect on your benefit commencement day. Unless you're grandfathered and you choose the first available benefit commencement date after your first day of retirement, in which case you can then use the interest that's in effect on your day of retirement. Okay. Let me restate it with dates because that might make it more clear for you. If you want the second quarter discount rate, then the last benefit commencement date in the second quarter is June 1. If you're grandfathered, you can say, no, I'm going to retire on June 29th, will be my last day on the payroll. My first day of retirement will be June 30th, and my benefit commencement date will be July 1st, and I get that exception that I mentioned a minute ago, the exception that I am grandfathered. I took the first available benefit commencement date after my day of retirement, and therefore I can use the discount rate on my day of retirement at June 30th. So for people who've been around a long time, but they're not grandfathered, and they've been talking to people older than them, they probably think they can keep working until June 29th. and have their first day of retirement June 30th and still get the second quarter discount rate. That only is going to work if you are grandfathered. You're over 64 and you've got over whatever I said, 20 years of continuous service. Okay. Hope that answered the question. So it's a lot simpler when we have these single equivalent rates, but that like just adds another complicating factor, which is, well, where the heck did you get those rates from? But before I leave this page, just eyeballing this, what you can see is that segment 2 and the single equivalent rate are real close to each other. So if you don't want to go to the trouble of back calculating this single equivalent rate, and you want just a quick and dirty, how much of a change is there from one quarter to the next, just look at segment 2 and ignore everything else. But okay, I'm going to get there as to how that works. Okay, so someone asked, what if you're between 55 and 60, which one do you use? The only reason we're using these is to do the comparison. So if you look here, you say 42 or 43 basis points difference. 0 to 3 basis points difference, 23 to 25. Yeah, the difference is not that big. And that's really the only thing we're using the single equivalent rate for, is to see how big of a difference do we have from one quarter to the next. So you can use either one or use the average. Okay, I showed you the 30-year Treasury bond going back to 1980. These series I can only do back to 84, but this is kind of what our single equivalent rate would look like if it existed prior to 2013, going back in time. You see the same kind of trend. One big difference you see is the bump up instead of down when a financial panic occurs. Okay, bump up instead of down when a financial panic occurs. And by the way, the line is the monthly data, and the blue dots are the discount rates shifted over to when they actually apply to. And so once again, we see where we're at all-time low rates before the pandemic. Then, of course, the pandemic came in, kicked rates even lower. They started up last year, but then came back down and are now on their way back up again. All right, now finally, we're going to get to how do you actually use these interest rates and see how they affect your lump sum. And before I get into the details on the slide, I want to point out what's at the bottom of the slide, that what I'm doing here is using a simplified method to illustrate the importance of age, life expectancy, and interest rates. This is not exactly the way that the calculation is done by the pension people, and you will not get things to agree to the penny when you use this simplified method. But you'll be within 1% of the right answer, and therefore, if you're making comparisons of two things that are within 1% of correct, you're going to be even closer than 1% correct on how big of a change does this make. Okay, so we've got the three segments that we know are right for the second quarter, and I'm taking someone who has this very unusual amount of $4,758.61 a month, or $57,103 a year, to build my table. And yes, I did this. I back calculated what annuity I needed to get $1 million lump sum as a nice round number for our comparisons that we're going to make. Okay. A person who's 60 years old and hasn't died yet has a life expectancy of 84. Okay. which means they're going to receive the annuity through their 83rd year, and then they're going to pass on their 84th birthday. Okay, so as far as I know, the question is, as far as I know, is that the right number? And I'll tell you, it's real close. So it's within 1 year of that number. And again, I'm doing a simplified example. And yeah, it's real close. It's real close. And that's why I'm using it. And so if you're a grandfathered person and you want to use this method, use 82, wipe out the last 2 rows of this table to calculate your lump sum, and you'll see whether this comes pretty close for your case or not. Okay, so you put these interest rates in, and what I want to point out is the difference between year 5 and year 6. So in year 5, we're still using the short-term rate. And in year 6, we're using the intermediate term rate. We're going to use the intermediate term rate for all 6 of those years. What we're trying to answer is, how much money do I need to invest for today for 6 years at 2.72 in order to have $57,103 to pay this person's annuity? And yeah, when they do it in human resources, they're not doing it by years, they're doing it by months. But I'm doing it by years to get it to fit on the page. So that's all there is. You multiply the annuity payment by the discount factor, you get the present value for each year, you add them all up, that's your lump sum. Okay. Now, segment 1 is the first 5 years. Short-term interest rate. Segment 2 applies to years 2 through 20, intermediate term interest rate. Segment 3 is a long-term interest rate for everything over 20 years. And I'll come to how I did it, but I come up with that internal rate of return, which is equal to the single equivalent rate of 2.69%. What if you're 55 instead of 60? Okay, first here's a question. If the life expectancy, once it gets updated after we have the COVID data, is there a requirement that they let you know about this so that you can make a retirement decision, or it will simply become effective? That's a good question. I don't know that there is a requirement to inform people about that. Okay. I don't know. We have to plead ignorance on that. So what if the person's 55 instead of 60? Okay. Now, the fact is that every year you don't die, your life expectancy goes up a little bit. So like if you looked at life expectancy at birth, and it says that it's like 79, well, okay, but what if you're 79 years old? What's your life expectancy? So every year you don't die, your life expectancy goes up by a little bit. And in this range of 55 to 60, it's not really a full year. I'm just going to illustrate it as if it were a full year. Okay, so you're going to receive your annuity now through your 82nd year instead of your 83rd year. But what that means is that you did gain 4 more rows on this table. And the first 5 are still at that segment 1, and the next 15 are still at that segment 2, and all the others are at segment 3. So you have more years exposed to the higher rate. And that's why back here, when I was showing the difference, the single rate is always higher for somebody who's younger. It's always going to be higher because they have more exposure to segment 3, which is always going to be the highest interest rate. Okay, but all the other math works out the same, that you calculate the discount factors from the interest rates, you multiply the discount factor by the annuity payment. Oh, I forgot to say, but the annuity payments are smaller, aren't they? So if that same person who was receiving $4,758.61 at age 60, at 55, they'd only get 75% of that, right? So they'd only get $42,827 a year. And their lump sum, instead of being $1 million, is $826,000 and change, which you'll notice is more than 75% of $1 million. Okay, so when we think in terms of the pension is cut 5% a year for taking the benefit before age 60, that's on an annuity basis, it's 5% a year. On a lump sum basis, it's about 3% a year. Okay, now if it was exactly 3% a year, that would be $850,000. So in this particular case, it's just a little bit less. And the reason it's a little bit less is because, remember, I took a whole year off of this person's life. Instead of, it would really be more like half a year if we use the actual actuarial data. Okay. And so someone asked, that 84 that I was showing over here for someone who's 60 years old, does that agree with the 2018 table? Yes. And the 2019 table would not be that much different. It would be a little bit higher. The 2019 table had a little bit higher life expectancy than the 2018 table. But again, as far as I know, as far as the numbers I've seen so far, I haven't seen any difference. Okay, so that's the difference between 55 and 60. Notice that you do have to add more rows at the bottom of the table. Okay, so how do we calculate the single equivalent rate? There's two different ways you can do it. You get the same answer either way. One way you do it is you would put in the lump sum as a negative number, and then the annuity as positive payments for as many years as you're expecting to get them, and then ask Excel to tell you the internal rate of return. So this formula in this cell is equal IRR, and then the range that has this data in it. Okay, and you'd get 2.69. That's simple. But another way you could do it, for people who don't like that formula for whatever reason, is you would take the table we had from before, but now put some number here. And I'd say a good first guess is the segment 2 number. That usually turns out to be real close to right. And then make all the other ones equal to that first number. And then use goal seek. So it's under Excel data tab, and then what if, and under what if, goal seek, and you'd be seeking to make that $1 million, or whatever the answer was in your case, by changing what's in this cell. And it'll give you the same answer. Okay. And again, this is all using the simplified method of calculating the lump sum from the annuity. So it's not going to agree to the penny with what you get from HR, but it's going to be definitely close enough to be able to make comparisons of how much difference is one quarter from another. Okay, so what is the impact of interest rate on lump sum? So I'm going to say the base case was this person retiring in second quarter at age 60, where he had the internal rate of return of 2.69, had a lump sum of $1 million. And then we're going to increase interest rate or decrease interest rates by these different percentages and see what kind of a lump sum we get. So if you increase interest rate, you get a lower lump sum. So, that's why it's called the discount rate. A bigger discount means a smaller price. Now, usually you like discounts because you're buying, but in this case, you own the store. You don't like discounts. Okay, so that's the way to remember this. As the discount goes up, the lump sum goes down. Or if we're decreasing interest rates, as the interest rate goes down, the lump sum goes up. And the rule of thumb that I've been using since 2006, when this law was first being talked about, and I started looking at these numbers and said, it looks like corporate bonds are about 1% higher than government bonds. So I wonder how much impact that is. And I calculated and I came up with 1% interest rate is a 10% change in lump sum. And you see, in this case, it's really close. If I did more decimal points here, this is not exactly 10%. It's a little bit worse. And in this case, we're coming from the lowest interest rates in history. A 1% interest rate decrease from this is, it's more than 1%. But in the range between 0 and 1%, this is very, very linear, very linear. So if you're happy with a rule of thumb, that's the rule of thumb. That's all you need to know. Okay. Now, someone asked back here, how do I calculate the discount factor? So one way people do this, which I don't recommend, is you would basically take 1 over 1.09 here, and you'd get, well, to two significant figures, you get 99%. And then you would take that number and divide it by 1.09 again and get this one. And that's going to work for the first 5 years. But it's going to stop working when you go from year 5 to year 6. So I wouldn't use that simple method. I'd use the more general method that'll work all the time. And that is, in this cell right here, is 1 over 1 plus 2.75% raised to the 6th power. And that's going to give you the 85%. 1 over 1 plus 2.72% raised to the 7th power should give you that number. And on down. Okay. Now, let's run a very specific example of someone who's going to retire in the 3rd quarter instead of the 2nd quarter. So instead of these interest rates, they're going to have these interest rates. But assume they had exactly the same annuity. Then, okay, this is their table, and it's coming out to $938,763. So basically, that means that it cut off 6.1, 6.2% off of their lump sum. And if we go back to what we said this was going to be, 0.58, 0.57 to 0.58, and we applied that rule of thumb, we would have said it would remove $58,000 when in fact it removed between $61,000 and $62,000. So the rule of thumb is not perfect. If you really, really want to get down to as close an approximation you can get, then you're going to use tables like this, or you're going to send me an email and say, hey, Pete, run these numbers for me. happy to do it. Okay. Now, let me tell you what's wrong with what I did right here. Because this only applies to two different people. It's real close if you're applying it to yourself, making a decision between June 1 and July 1. But probably if you stay till July 1, you're going to stay till September 1. And so it's actually 3 months difference. So now you have to say, am I less than 60 or more than 60? If you're more than 60, well, then it's almost entirely the interest rate. Not entirely, but almost entirely. If you're not yet 60, then you've got that 5% a year on an annuity basis or 3% a year on a lump sum basis. 1/4 of that is going to apply here. So you get a benefit of a couple of percent for staying. If you got a big raise this year, then every month you stay, that raise counts more and more and more into your pensionable pay. So that's going to make the annuity and the lump sum bigger by a little bit. So if we go back to the difference between the first and second quarter of the year, and had quite a few clients who asked us to run the numbers. And what it turned out was that most of the time, for somebody who was not yet 60, for somebody in this category, that this little bit of change in interest rate was not enough to say they were better off to retire in the first quarter. Their salary plus how much the pension would go up offset the fact that the interest rate meant that it would go down a little bit. So for people who are over 60, it was reversed, that the interest rate was more important because the only additional benefit you get after age 60. Well, if you had a big salary increase, you get that no matter what your age is. But you don't get that 5% a year bump. And the other factor is another quarter year of service. So when they calculate your service, they calculate it to 4 decimal points after the number. So, and it's always benefit commencement date, which is always the first of a month. So every day counts at 4 decimal points after the number, okay? Every single day of service counts. And so how important is that? Well, depends on how many years you have. If you've only got, say, 20 years with the company, 1 over 20 is 5%. So 5% a year if you've only got 20 years. If you got 40 years with the company, 1 more year is half of that, 2.5%. Okay. So when you're making the decision about, do I go this quarter or do, second quarter or third quarter, basically in this example, it's not just the interest rate. There are other factors that say, well, if you work longer, it'll be a little bit better. The size of this interest rate change is about as big as we've seen in decades. And the real question is, will these things keep going up? If I go all the way back to this page that's showing, this is February, and it's kind of scary how fast these are going up. But we don't know, does that mean that they will have gone up that much more by the end of February, and will they keep going up in March? Okay, there are people who say the market has already priced in the moves that the Federal Reserve is going to make. And from this point, it's just going to be small changes as people read the tea leaves differently. Okay, I don't know if that's entirely true or not. In the stock market, that's probably true. In the bond market, interest rates are not the only thing the Federal Reserve's been doing. They've also been buying bonds actively, and that affects interest rates, and they're winding that down and buying less bonds. So all I can tell you is anytime I try to guess interest rates, I turn out to be wrong. So I'm not even going to try to guess. I'm just going to say it's possible these things will keep moving up, and it's possible this is as far as they're going to go for now. I'm not predicting. Whoop, went too far. I want this one. I'm not predicting they're going to pop back up to 4% equivalent rate. Okay. They may get there in time, but I don't think they're going to make a leap from here all the way to there in one time zone, one quarter. Yeah, anything's possible. If you look back at history, look at that drop. You know, that's huge in one quarter. But of course, that didn't really happen. This is just me backcasting what would have happened if these rates existed going back that far. This law, and therefore the calculation of this imaginary series of HQM bonds, only started in 2013. Okay. Now, I mentioned earlier that you have another option, which is to retire and delay taking the pension. Okay, when would you do that? Why would you do that? So first of all, you'd only do it if you don't need the money right away. Most people need the money right away. So, most people, it's not really an option to consider. The other is, you know, if you're retiring before age 60, and you're going to get that 5% a year bump up on an annuity basis, 3% a year on a lump sum basis, then that's kind of working in your favor, okay? Or if you're taking the lump sum and you expect interest rates to fall. Well, of course, we don't expect interest rates to fall. We expect, well, they're going up. But okay. For how long, we don't know. Will they turn around and go back down again? Well, something has been driving this downward trend in interest rates. Government bonds we saw before, corporate bonds you see here. Something drove these down to the lowest in the history of mankind before the pandemic. And you know, if whatever that something is that's driving these rates down still exists, yeah, they may go back down again. Okay, but I don't know when. Okay, so let's suppose that you listen to all of this and it made you decide, I got to go in June. I can't afford to wait until July. Okay. So what would be the roadmap for someone who wants to have their benefit commencement date, that's what BCD stands for, of June 1? We have two versions of this, the pretty colorful one and the I'm a dorky engineer one. I really like the dorky engineer one because that's me. So, okay, so what it says is 90 to 120 days ahead of the benefit commencement date, you should inform your supervisor and request your intent to retire package. Well, 90 days would make it March 1st, 120 would make it February 1st. But I would say that 90 to 120 days is kind of out of date for most people because it used to take them 4 to 7 weeks to print out an intent to retire package. And now they can usually do it in a couple of days. Now, if you're an executive, it may take longer. But if you are, call me. I'll tell you what you can live on while you're waiting for your check, because it'll be late in that case. But okay. So there's sort of two steps in this informing. One is informing your supervisor in writing. Doesn't have to be formal, an email is good enough. And the other is to request the intent to retire package from benefits. So then time goes by and you will receive what we're calling here the intent to retire package. It's funny, that's what you requested, but that's not actually what you receive. What you receive is the benefit commencement package. And so that package needs to be notarized by you, if you're married, by you and your spouse, and then you make the election of the lump sum or the annuity or 50-50 or 75-25. To the extent you're taking a lump sum, you fill out the qualified rollover form. Where's the lump sum going to, so that it's not all immediately taxable. And these two need to be notarized. The address verification form and the non-qualified pension election form if you have a non-qualified pension portion. You go, well, how do I know that? You know that if you have a supplemental savings plan, when you log into Voya, it gives you an option for a supplemental savings plan, and that is not zero. In that case, you're more than likely going to get a non-qualified pension election form as well. Okay. I missed a question over here. If you delay your benefit commencement date, but your last day on the payroll is the same, are the timeframes and the dates the same? Well, if you delay your benefit commencement, then remember that the discount rate that's going to apply if you take the lump sum is going to be the discount rate that's in effect on the day of your benefit commencement, not the date of your retirement. Okay, so even if you are grandfathered, the only way you get that option of taking the discount rate on your day of retirement as opposed to the benefit commencement date is if you took the first available benefit commencement date. So then that exception is out the window for everyone if they delay. And you're back here on you'd only be doing that if you expected interest rates were going to fall. I'd say that's kind of risky right here. Okay, so anyway, long and short of this is that this roadmap is saying if you want the check to show up June 1, you've got to have the form completed and back to the benefits office 35 days in advance. And I'll tell you, 30 of those 35 days are required by federal laws. So it's not just ExxonMobil being slow and pokey about this thing. And the 5 extra days that they add on is in case you made some small mistake that can be corrected quickly. It's not because they're trying to hold up anybody's checks. But 35 days ahead of that is ahead of June 1 is in April 27th, the latest day that you can get the package back to Human Resources in their hot little hands. Okay. Now the rest of this has to do with rolling out of Voya. You don't have to do that immediately. We're just illustrating that most people do. And so kind of what is the timing for rolling out of Voya, but I'm not gonna cover that today. Okay, what should you do now? Well, you should have a plan. If you don't already have a plan, come see us. We can help you work one up pretty quickly. The most important part of it is your spending budget. So basically understanding your cash flow and your anticipated expenses and understanding how much investment risk you're willing to take. Those are the things that you really need to grapple with to be ready to make that retirement decision. Okay, so someone asked the question, what's the probability of how many interest rate changes we're going to have to get to what the Federal Reserve wants to do to control inflation? And so the answer to that is the low end 1%, the high end 1.5%. There was a lot of debate about would their first rate hike be shock and awe, to be 0.5% instead of their normal 0.25% move. But the thing is, what the Federal Reserve is changing is the overnight bank lending rate. All these other rates are determined by the market. And so if you ask, I mean, it seems illogical that they could raise the overnight rate higher than, say, the 20-year bond rate. Okay, seems illogical, but it happens. So yeah, if the bond market is going to go up 1 to 1.5%, then are we there yet? With these two moves, we're getting close to 1%, but not to 1.5%. But again, the longer term bonds don't always move as much as the shorter term bonds do. So even if the Federal Reserve increases interest rates by 1.5%, it doesn't necessarily translate into long-term bonds of 1.5%. They could go up more than 1.5%. So it all has to do with the market. And generally speaking, interest rates are going to go up in the market faster if people perceive that the economy is doing really well. And if they perceive the economy is teetering on a cliff, interest rates don't go up as fast. So you'll see that economic news will drive the interest rates even more than the Federal Reserve saying that they're going to raise interest rates. Okay, so I'm out of time. Some people are leaving already. I just wanted to say that we record these events. You can find them at bogartwealth.com. Look for resources, events, video events, or you can just remember the URL, video events. If you receive the invitation for this from a friend and you want to get on the list, just put your name and email here. We don't even ask for a phone number. We're not going to bug you about it. The other way to do it is our Contact Us page, where we will ask for a phone number. But, if in the message it says, please don't call me, I just want to, be on your interest rate mailing list, then, we're not going to call you. So again, the not hidden message is we would love to get together with you one-on-one, any one of our advisors, and I'll leave this page up with the advisors' contact information if you want to write or call any one of us. Thank you. Hope to see you at another seminar. I'll stick around for another minute or two if there's any other questions. Otherwise, that's all I had for today.